Right, welcome to the session. I just decided to have a lesson unit now with regard to the market interest rates and term structure of interest rates, where we couldn't have a lesson on that topic. So therefore, today we will discuss about market interest rate mechanisms and the term structure of interest rates. Now, this is a very important lesson where you have to get a clear knowledge about this. Otherwise, it is very difficult for you to look at the interest rate instruments. So therefore, this knowledge is very important for your investment and portfolio management lesson. That's why I decided to have this lesson. Actually, at the beginning, I didn't have a very clear idea about whether we are going to have it or not. But anyway, what I feel is I just felt that it is a very important lesson. So we will just go into that, and I expect that you really follow it in a effective manner. So then you will be in a position to just work out any type of problem of that nature. Right. This is marked as the lesson 7, and the topic is market interest rates and term structure of interest rates. And we will discuss these subject areas under the lesson unit: the level of market interest rates, yield spreads, then the term structure of interest rate theories. Now, our emphasis is given on these theories: the expectations hypothesis, the liquidity premium hypothesis, and the segmentation hypothesis. Now, these hypotheses are really deciding the levels of interest rates in the markets, and to explain the different interest rates for different instruments, these hypotheses would be used. Then at the end of the sessions, you will have related worked examples and some other exercises also. So before going into the details, what I want to tell you is the interest rates. It is the price given for funds. So therefore, when you want to just learn on interest rates, we are learning about the price. And why we learn about prices? We need to observe and we need to understand the behavior of markets. That is the intention of learning interest rates and the mechanisms of interest rates. The first topic, that is the level of market interest rates. There are numerous types of interest rates, and I think you have already heard about different levels. You heard about real interest rates, nominal interest rates, market interest rates, prime interest rates, and expected rates. There are several. Now I just gave you a certain standard type of explanation. When you say market interest rates, that consists of real interest rate plus expected rate of inflation plus various risk premiums. Now, when you say the market interest rate for a particular bond is so much, say 12%. Say it's a corporate bond. If it is a corporate bond, then the market rate, interest rate or yield to maturity of a corporate bond is consist of its real interest rate plus expected rate of inflation plus risk premium. So therefore, we don't know what is the real rate of interest in that particular bond. What is the expected rate of inflation in that one? What is the risk premium in that? But if you get a government bond of the same maturity, you will see a difference with the corporate bond. Now, for example, if the corporate bond of a 10-year maturity is 12%, the market interest rate of a 10-year corporate bond is 12%, and 10-year treasury bond is 10%. Now you can gather something from that. That 2% increase of a corporate bond can be attributed to the risk premium. So therefore, in that case, the risk premium is 2%. Because the government treasury bond, we assume that government treasury bond does not have a default risk. So therefore, in the government treasury bond, you get only the real interest rate plus the expected rate of inflation. So therefore, now you can get some idea about these interest rates. Now these market rates are also known as nominal interest rates. So therefore, there are no, we can't say these are two types, but the same type we are referring to in different stages. But market interest rate and nominal interest rate referring to the same idea. Now we will see what is this real rate of interest. It is the rate at which physical capital is expected to reproduce in an economy. So it's a type of a general term where capital production or producing capital in an economy is done at this rate. It is the real interest rate. Since suppliers of funds expect to be compensated for inflation, now say, when supply means the person can invest capital funds. So the rate applicable for that type of investment can be taken as real interest rate. But the capital providers may not satisfy with that rate. They need more. That is the expectation for inflation. So therefore, rate given for these capital providers can be taken as real interest rate plus the expected rate of inflation. Now, if you take a bond into consideration, the yield of the bond can be taken into consideration together with these different levels of interest rates, real interest rates, expected rate of inflation, and the various risk premiums. Now we will go into a discussion of different risks. The first of that is default risk. This is the risk of bankruptcy and therefore the inability of a corporation to pay the contractual interest on debt. Now, corporation in the sense, now say for a bond, I think in this particular lesson, our main instrument is a bond. Therefore, the terms are being explained in terms of a bond. The inability to pay interest means for a bond. So that is what you call default risk for a bond. And it can happen through a bankruptcy of a firm. Then you go into the liquidity risk. The risk of not being able to sell an asset quickly at full value. That is what you mean by liquidity risk. Now for a bond, you can just imagine what is really happening. Now, in a scenario where the liquidity is not available in the market, it is very difficult for you to sell a bond. Even if you want to sell a bond, you need to sell it at a low price than the fair price. So if that is the case, we consider it as a liquidity risk, because the full value means you are not in a position to get, because when the interest rates are very high or whatever, then you can realize a very low amount. So that is the issue. So selling is difficult and getting a price is also difficult. So if that is the case, we say that in the market there's a liquidity risk, or illiquid markets we call it, illiquid markets. But that is another risk bond seller will have to face. Then you come to the third one, that is interest rate risk. The fluctuation in price, especially for long-term bonds, from changes in the interest rate. Now, that is a risk. I think we all went through that lesson on duration and all. Duration is the measure of interest rate sensitivity. Then we studied there, when there's a rate change in the economy or rate change in the market, the value of the bond changes. If there's a rate increase in the market, the value of the bond goes down. So that is the risk. That is the income effect of interest rate, sorry, value effect of interest rate risk. And the other thing is, when interest rates go down, the reinvestment, there will be a reinvestment risk, because the reinvestment cannot be done at the rate which you have done it earlier. So that one is also coming under the interest rate risk, but we give another name for that. We call it reinvestment risk. Then the number 4 is taken as foreign exchange risk, the risk of holding bonds in a foreign currency. That is taken as foreign exchange risk. Now you can see, for a particular bond, you may have to face with all these risks. Default risk comes with basically it won't come with the government bonds, but other than government bonds, you have to face default risk. And liquid risk, it can come in government bonds also. So therefore, there's no difference here. Even the government bonds cannot be sold at some instances. So therefore, this can come for a government bond. Interest rate risk, that also can come for a government bond also, because the price fluctuations are very much usual or very much regular in markets. Therefore, you can't avoid this even with the government bond. Then foreign exchange risk. That is, of course, applying to the foreign currency bonds. So, for example, if you go for a dollar bond in Sri Lankan markets, then you have a foreign exchange risk there, because the currency involved is dollar in the bond. If you have any issue or any clarification, you can raise question now, because this is an important lesson and you need to have some qualitative idea about these things. In order to do analysis, you need to have this qualitative knowledge. Right. Now we will move into the next topic, that is yield spreads. Yield spreads are the differences in yields between risky bonds and default-free government treasury bonds of similar maturity. I think I have already explained about such spreads. or the additional interest charge. That is what you mean by the spread. Now, if I get an example here, suppose an AAA grade bond comes, corporate bond, current YTM is 11%, while the YTM on a similar treasury bond is 9%. The yield spread for the pair of bonds is 2%. It is very simple to say that. Now, the yield spreads value, either 2%, 3%, 1%, or whatever it is, it really depicts the market situations, the risk levels, and all that. As per the market's expectations. Now, just to say that yield spreads tend to vary over the business cycle. It tend to vary over the business cycle. Now, what do you mean by business cycle? If you go into a certain type of a business organization, in the business cycle, you have a growing stage, then first stage is the initial stage, then the growing stage, then maturity stage, then declining stage. Likewise, you have a cycle. Now, in a business cycle, they are larger. The spreads are larger at business troughs than at peaks. Now, if a business is at its peak, then people might think that the risk is lower for that particular business, and granting advances or getting a bond or invest in a bond of that particular organization would not be such risky. So that is why, if the business is in a trough situation, upper level, trough situation means is a down level. If it is in a down level or lower level, then the yield spread has to be higher. But if it is in the peak level, people think that the particular organization, the particular issuer is at a lower risk. That is why in peaks the spreads are lower, and in troughs the spreads are higher. And these spreads are really more or less predictable, because the market, the people who are active in the market, they can predict the spread fashions. Bond traders and investors who can act quickly when yield spreads appear to be different from normal can make profits, because now they know how they can make use of arbitrage opportunities by looking at the yield spreads. For example, say, as per the market, the investor might think that a AAA corporate bond for 10-year maturity is normally the yield to maturity of such a bond would be, corporate bond, say 10.5%. Whereas he might find in the market a particular bond selling at 9%. But in terms of price, if it is 9%, the price is higher. So therefore, what he can do is, he can purchase that bill from low price place where it is 10.5. 10.5 means interest rate is 10.5 means the price is low. You can purchase it from that end and sell it to the high price place where the interest rate is low. So such type of manipulations, most of the time the investors and traders do. Then the term structure of interest rate theories. Years to maturity for the bonds, holding other things constant, is called the term structure of interest rates or yield curve. Now say the maturity period and the interest rate, the relationship between these two is called the yield curve most of the time, and we call it term structure also. Now this term structure is based on three main expectations. Now we will have a explanation of all these things. First of that is the expectations hypothesis. Now you look at it, the expectations approach to the term structure of interest rate states that long-term interest rates are the geometric mean of expected forward short-term interest rates. This can be expressed as follows. Now, since this is done in notation, I will put it in terms of normal letters. Then you will really understand what it is. I will put it on the board without using the symbols, without using the codes, right? So then you can understand the things in a better way. I will put it that way on the board. Now, here you can see some expression as F12. That is the forward rate, expected forward rate for the second year. Now, you just look at it from first year. Expected rate for the second year is the expected forward rate which you expect from first year. That is F12. If you expect from a 1 year forward rate, expect from second year, that is taken as F23. Likewise, the notation is given here. So I will show you it on normal letters without using the symbols. You can just look at the board. I have taken an example of YTM for a 4-year bond. YTM for a 4-year bond is equal to 4th root, because you are referring to 4 years. Therefore, you get multiplication of 4-year rates. First term would be 1 plus YTM1. That is the YTM for 1 year. So then plus 1 plus F12. The meaning is the forward rate, the second forward rate for the second year. That is F12. Then F23 is forward rate for third year from second year. Then you have F34, that is forward rate for fourth year from third year. 1 year forward rate we are talking about. And it has to be multiplied with each other and get the 4th root of it, minus 1, will give you the YTM for 4 years, 4-year bond. Now, that is the explanation given in the text. Now in the text, this one I have just given in normal form, the equation A. Here the YTMN is the YTM on a bond maturing in periods. Now I just gave you an example. The YTM on a bond maturing in 4 years. The example I have given. Then if T minus 1T means the expected forward interest rate on a bond originating in period T minus 1 and ending in period T, the forward rate. Now in the same manner, when I say F12, the meaning is it is originating in at the end of the year 1 and ending in the period 2. So that is the 1 year forward rate. I will just give you a small exercise to do. Then I can just get your understanding on that. So I will put a small example. Or shall we go to a right? Okay, we will go into the next two equations also, and afterwards we can have a exercise. Now what I ask you is whether it is you understand this particular equation. So I think it will be more clear when you make use of these things for calculations. Till that time, I think you can just wait. Then you will understand whether it is understood, whether it is clear or not. Right. Now we go to the equation B. It's a derivation of the earlier one. And in other words, it says the forward rate originating from T minus n to T is equal to 1 plus YTM T to the power T minus divided by 1 plus YTM T minus 1 to the power T minus 1 minus 1. This will be the forward rate calculation using the YTMs. That is given by equation B. Equation C. Now it's a type of, now here you have only a difference of 1 year. But here you can see a difference is n years. It can be any amount, n years. When you have n years difference in the future or forward rate, so in other words, you can say you will have to get the 3-year forward rate from second year. That means F25, 3-year forward rate from second year. So that means F25. So that is how the notation is given. So when you have that type of forward rate, the calculation is this: 1 plus YTM T plus N to the power T plus N divided by 1 plus YTM T to the power T. And whole thing you have to get the nth root minus 1 will give you the forward rate for n years. Now when you go to the liquidity premium hypothesis, while the expectation approach, now we have already discussed these 3 equations, A, B and C are referring to the expectations hypothesis. Because why we call it expectation hypothesis? Because we are talking about a forward rate. It is an expectation. Expected forward rate, we call it. Expected forward rate. So therefore now that is named as expectations hypothesis. Then we have another hypothesis called liquidity premium hypothesis. While the expectation approach to the term structure of interest rate implies a flat yield curve, if interest rates are not expected to change in the future, the liquidity preference theory under similar circumstances implies a rise in yield curve. So that means if you assume that no any other risk is applicable, then there's a interest rate applicable to liquidity premium. Or according to this rule, liquidity preference theory, investors demand a risk premium from long-term securities. Now, if you get a long-term bond or whatever, the investors expect a higher rate for longer-term securities. So that is the liquidity preference theorem. Now, if you get a short-term bond or whatever, there you don't need to. There the investors don't expect a higher return from short-term type of securities, but if it is a longer-term security, they expect a higher return. Why? What is the reason? As long-term bonds have more interest rate risk, investors require higher returns. And not only that, they need higher returns in order to deal with liquidity risk also. Because when the bond is longer term, the liquidity risk could be high. Then the segmentation hypothesis. According to segmented market theory, a certain investors and financial institutions prefer to invest in certain segments of the yield curve. So what does that mean? Some investors, they want to invest in short-term type of bonds. Some investors want to invest in longer-term funds, longer-term type of securities. Now you can just see the example given here is the long-term liabilities of pension funds. Now pension funds also, now they are dealing with longer-term funds, and they have to pay pensions for the employees, and in order to do that, they need to grow their funds. They grow their funds through longer-term investments, and pension funds prefer to invest in long-term securities. Now that is their hypothesis. That is the segment. Their segment is long-term segment, and they go for that. So that is another expectation for interest rate risk or interest rate, the rate. Therefore, now if you find so many pension funds in the market, then there will be a demand for such investments. When the demand goes up, what will happen? The price might go up. So therefore, interest rates will be higher. Or there can be a particular interest rate applicable for that segmentation basis. Now, on the other hand, commercial bank short-term liabilities create a need for short-term assets. As a result, supply and demand for funds within each segment of the market determine the level and structure of interest rate for the segment. So this is a type of theory which you need to understand, which is called the segmentation hypothesis. Now, in brief, what it says is the interest rates can vary from segment to segment. So segment to segment means it from corporate segment, retail segment, SMI segment, then long-term, short-term, whatever the segment may be, there can be a change in interest rate. That is what it means by segmentation hypothesis. Now we will go into a worked example. The following yield structure was in existence on August 31st, 2020. Determine the missing forward yields. Now, missing in the sense now in second year, this is missing. In fourth year, forward rate is missing. In fifth year also forward rate is missing. So first of all, we will try to get the forward rate for second year. How are we going to get it? Now we will see what is the way we can do it. Now, even though we miss some forward rates here, you can see the YTMs. You can see the YTMs. Now, we need to get the forward rate. Now, this is the rate it is missing. So, it's the rate originating from 2020 and ending at 2021. That is what you call the 1 year forward rate in 2020. Expected for 2021. So that is what you call the forward rate, and it is symbolized by F12. F12, we call it F12. Now we are going to arrive at F12. F12 is equal to 1 plus YTM2 to the power 2 divided by 1 plus YTM1 minus 1. So YTM2, what is the meaning of YTM2? The 2-year bonds YTM is the YTM2. That is 7.5. So therefore, we can put it as 1.075 to the power 2 here, because it is 2. Then divide by 1.07, it is 1. The year 1 YTM, that is YTM1, this is the year 1 YTM, it is 7%. 7% is 0.07 and it is 1.07 here. And when you work it out, you got this answer 0.08. And it is 8%. So therefore, F12 is equal to 8%. Now just get the idea how to calculate it. Now, first of all, you can write these things. Then you can see whether what type of data is given. Now I will ask you another thing to be done. So how are we going to say forward rate for the fourth year? Or say, no, I'm just referring to another one, right? Here, forward rate for year 5, expected forward rate for year 5. From looking from year 4. How are we going to put it? We can put it as F45. F45, right? F45, and then right. I will ask you to write down that. I don't know whether it is possible, but anyway, I don't know whether this is given here. 45 is given here. Right, now you can just check that. Now when you have to calculate the 2024, the 1 year forward rate. Here, in 2024, what is the 1 year forward rate? That means we are referring to 2025 and it is referring in 2024. So that is what you call the year forward rate for next year decided on 2024. So that is given as F45. Now just look at it. 1 plus YTM5 to the power 5 divided by 1 plus YTM4 to the power 4 minus 1. Now, in the table, you can just look at YTM5, that is 9%. So you get 1.09 to the power 5. Then what is YTM4? It is 8.5. And you can put it as 0.085, 1.085 to the power 4. And when you calculate this 1 point, now you should know how it is to be calculated. You need to have a scientific calculator. And in the calculator, you get YX. So what you need to do is, now, in order to calculate the fifth power of 1.09, what you need to do is, you need to just press 1.09, key in 1.09, and press YX. Press YX, y to the power x, and press 5. Then press equal mark. Then you get the answer. The answer would be 1.53862. If you go for the next one, that is 1.085 to the power 4. 1.085 to the power 4. YX, that is y to the power x, and 4 equal mark, then you get 1.38585. Right. So now I am asking you whether you are familiar with this calculation, power calculation. If you are familiar with power calculation, then there's no issue. You can really calculate it. Are you clear with the power calculations? Because you need to do it using a calculator. Because in your calculators, there's a button y to the power x. Y to the power x. That button you have to use in power calculations. Or otherwise, there are some other calculators where arrow mark is available. That arrow mark depicts the power. Right, we will go to the exercise again. Now you see, under this calculation, you arrive at 1.1102 minus 1, that is 0.1102. As a percentage, it is 11.02. So that is the forward rate for year 2024. Now that calculation has to be done as against the earlier year, 2023. Now 2023 one is calculated on the basis of 2022. So that is 3.4. That was calculated earlier. Right, before going to more details, I will just ask you to do some exercises, because otherwise now you really don't understand it, and then you feel bored also if you don't do anything here. So therefore I will give you a small exercise to be done. Right. I have put something on the board. Now you just look at it. You have here 1, 2, 3, and 3, 4, and 5. The forward rate, some of the forward rates are given. YTM is given. What you need to do is you need to fill the blanks. That is, you have to get the forward rate for second year, forward rate for fourth year, and forward rate for fifth year. So can you do that and just do it? And first of all, you need to do the forward rate for second year. That is F12. That is F12. Just do it and come up with an answer. Because without that, you may not be in a position to get it understood. So therefore, you try your best to come up with the answer. The first of all, you need to do this blank to be filled first. In other words, it is the forward rate for second year, originating from first year. You can note it down. You can note it down. Yes. And just look at the now I have just made more blanks now. So what you need to do is you need to fill these gaps. Now the first gap, number 2. So that you need to do. So have you done it? Now how can you symbolize this? So that can be taken as F12. So F12 is equal to 1 plus YTM2 to the power 2 divided by 1 plus YTM, 1. Here you can see. Yes. Has anyone come to the first point? What is the answer for this? Yes, correct. 14% would be the correct answer. Now I will just explain it this way. In order to get this, we have to have, now this is the second year. So therefore, this is the forward, when you say forward rate of 1 of 2. So you are expecting the forward rate for second year in the first year. So it can be simplified as F12 equal to 1 plus YTM2 squared divided by 1 plus YTM minus 1. This is the formula. So YTM2 is 13%. And we have to put 1 plus YTM2 squared. That is 1.13 to the power 2 divided by, what is YTM1? YTM1 is 12. So 1.12. And do the division and deduct 1, then you will come up with 0.1400 something. So that means the value is 14%. Value is 14%. Right, good. Now if you do the other calculations, so what is the next calculation? There you can say F23. F23 is what? 1 plus YTM3 to the power 3 divided by 1 plus YTM2 to the power 2 minus 1. So that is the third one. So for the year 3, you can get the forward rate for the year 3. Pimali and Madhuma Madhuma done well. I mean, they did the correct. They got the correct answer. I think better if you can put it in percentage form rather than having it in a decimal form. Right. You just do the third one also. Yes. Can you try the second one also? Second one is year number 3. Forward rate of year number 3. What is it? Now when you want to do it, what you need to do is you have to get 1 plus ytm3 to the power 3 divided by 1 plus ytm2 to the power 2 minus 1. So that is the way of calculating it. So I will just do it for you. When you say 1 plus ytm3 to the power 3 is 1.15 to the power 3. That comes to 1.520875 divided by 1.13 to the power 2. That comes to 1.2769. It is equal to 1.19106. The answer would be 0.1911. I think the Shanali's answer come closer. I don't know. You have just made mistakes if you don't get the answer. But anyway, this is the way it can be done. I will just work it out and show you. Now we need to get this. First of all, you should symbolize that. Now it can be symbolized as F23. So what is the formula? 1 plus ytm3 to the power 3 divided by 1 plus ytm2 to the power 2 minus 1. So this is the way it has to be done. Then what is ytm3? 15%. So 1 plus ytm3 is 1.15 to the power 3 divided by ytm2 is 13, 1.13 to the power 2. And if you work it out, then you will get the answer. 19.05. Wait. I think it is more or less correct. 1.15 to the power 3. Now, when you say 1.15 to the power 3, it comes as 1.520875. It is to be divided by 1.13 to the power 2. That comes to 1.2769. It is equal to 1.191068. If you go into 4 decimals, the answer would be 1.1911. Then you deduct 1, then you will get the answer as 1911. 19.11 is the answer. That is correct. 19.11 is the answer. That's correct. Rivini's answer is correct. $19.11 is the answer, not 19.05. I think you are rounding off error if that is the case. F34. We will see what is F34. 19.11. Right. This is 19.11. Now F34 is what? There you get F34. Now you can have the same type of a formula. F34 is equal to 1 plus ytm4 to the power 4 divided by 1 plus ytm3 to the power 3 minus 1. So we will do that. 1 plus ytm4 is 1.16 to the power 4. That is equal to 1.8106 divided by 1 plus 1.15, that is ytm3 to the power 3, 1.15 to the power 3. There also you get 19.05. That is correct. F34 is 19.05. F34 is 19.05. Correct. Now we will see what is F45. F45 would be 1 plus YTM 5 to the power 5 divided by 1 plus YTM 4 to the power 4 minus 1. That is 1.18 to the power 5 divided by 1.16 to the power 4. So you get the answer as 1.2635. And the answer would be 26.35. That is correct. 26.35 is the correct answer for F45. I think with the calculations of numberings and actual calculations, you get it understood. And this symbolic expression is also important, because with the symbolic expression only you will get the correct formula. Otherwise, the correct formula is not really received. So therefore, if that is the case, you will not come up with the correct answer also. So in order to get the correct answer, you have to apply the correct formula. I think the people who have done the things, they did it correctly, and I am happy about that. We will see the next point where we have to go through some other type of a thing. Right. Shall we go to the second one? The second question. The YTM on a 7-year T-bond is 9% and the YTM on a 10-year T-bond is 10.5. Determine the implied average forward rate for a 3-year T-bond starting in year 8. Year 8. Now, when you say starting in year 8, it will end in year 10. Now, in other words, at the end of the 7th year, it starts. So how are we going to get it? So what is the code for that? F what? F710. We put it as F710 because you are referring to a 3-year bond, YTM of a T forward rate, implied average forward rate for a 3-year T bond. Now, we are not going to get a 1-year period's average forward rate. We got the forward rate for 3-year bond. That is the difference here. So therefore, you have to apply the other formula. Other formula in the sense, now the years are not consecutive. This is a 7-year bond and this is a 10-year bond. So there's a difference of 3 years. So that means you have to apply the other formula. Now, what is that? So how are we going to apply that? Now here it says, now we symbolize it as F710. F710 equals to 1 plus YTM 10 to the power 10. YTM 10 means YTM of the 10-year bond. 1 plus YTM 7 That is the YTM for the 7-year bond. And you have to get the 7th power. And get the result, and you have to get a third root of the root of this. That why the 3 comes here? 10 minus 7 comes as 3. That is how the 3 comes here. Then we will see what we did. YTM 10 is 10.5. It is given in the 10-year T-bond is 10.5. So that value is applied here. So therefore it is 1 plus YTM 10 is 1.105. And to the power 10. And the 7-year T-bond, the YTM is 9%. So that comes to 1.09 to the power 7. Now you will, if you can get a calculator, then you can do the calculation and see whether it is correct. 1.105 to the power 10 equals 2.71408. And that has to be divided by 1.09 to the power 7. That comes to, the answer is 1.48469 or 468. And we have to get the third root of that. Third root. How are we going to get it? And you press YX 3, and you get 1.1408. So the answer would be 14.08. Now make sure that you do the correct calculations. And how are we going to do the correct calculations on this? Because to calculate the roots, now when you say third root, that is the 1/3 power, 1/3 power, 1/3 power. So that is how you do the calculations. Have you understood this? Because there's a gap higher than 2, higher than 1. So therefore, the root comes here. Any question on this? Any question on the second one? Because that has to be understood in a different way, because the two bonds we are referring to are the years are different, because one bond is 7-year bond, the other one is 10-year bond. We are talking about 7-year bonds YTM and 10-year bonds YTM. Right. I will explain the calculation. Now in our in our exercise, we need to get the rate, forward rate for 3-year bond on the 8th year, starting at 8th year, or in other words, from 7th year. Then we have to symbolize it as what? F710. F710. This is the symbolization of that. So that we can say is equal to 1 plus YTM 10 to the power 10. You always see the number here and the same has to be powered here. 1 plus YTM 7 to the power 7. Not only that, you can't just stay here. You need to have 10 minus 7 is 3. You need to put 3 here. That is, the meaning here is third root, not the third power, it is third root. If you put it in power terms, it is 1 over 3 minus 1. This will be the answer. This will be the answer. So 10-year treasury bonds YTM is 10.5. 10.5. So therefore, we can put it in this way: 1.105 to the power 10 divided by 7-year bonds YTM is 9%. That's all, yeah, 9%. If I remember correct, is 9%. So, shall I? Yeah, it is 9%. So therefore, yeah, you can put it as 1.09 to the power 7 minus 1. Now, using the calculator, you need to do this. 1.105 to the power 10. That comes as 1.105 to the power 3 to the power 10. 1.105 to the power 7. So if you have a calculator with the button y to the power x, you have to press that button first and then key in 10 and equal to, you get a value 2.7140 or 408. So you can say 2.7141. Divided by 1.09 to the power 7. 1.09 to the power 7. So that can be calculated through 1.09 yx button, then press 7 equal to, that is 1.8280. Minus 1. Now what we need to do is, we need to do this calculation 2.7141 divided by 1.8280. 2.7141 divided by 1.8280. That is equal to 1.4847. 1.4847 third root minus 1. So what is the third root of this? How are we going to calculate that? Now, even using the same button, we can do that, but there's a particular way. You key in 1.105 4847. Now we need to get the third root of that. So you press y to the power x button and press 3. But you can't just wait there. You have to press 1 over x button also. 1 over x button and press equal mark. Then you get the answer. 1.14080. So therefore it will come as 1.1408. And the answer is 0.1408, or as a percentage 14.08 is the answer. Is that okay? I think that gives a fair explanation. Right, good. Now then we will go into another question. Right. Now we will go to the next problem. That is, suppose the real rate is fixed at 3%. If the following inflation rates are expected for each of the next 5 years, determine the yield curve for the risk-free bonds. Now, as it is, you now realize that the particular problem discusses about the risk-free bond. So there's no risk at all. So therefore, we don't need to adapt a risk premium here. But we have to adapt the real rate plus the inflation. But the issue here is, in order to issue a yield curve, only the expected inflations are given. But you have to get the average inflation. But expected inflation for the particular year is only given. But when you do it today, you need to expect the inflation for the number 1 year. That is not the expected one, that is the current one. Then expected one is the 4.5, that is the second year. Third year also expected from first year. So therefore, what we need to do here is, we need to get the expected inflations for 2 years. How are we going to get it? Now, expected inflation for 1 year is 4%. But this 4.5 is not the expected inflation for 2 years, but it is only the year 2. It is not for the both years cumulatively. What we need to do is, we need to prepare a cumulative type of inflation figure. How are we going to do that? In order to get the cumulative inflation for second year, what we need to do is, we need to multiply 1.04. That is 1 plus 4%. 1 plus 4% means 4% means 0.04. 1 plus 0.04 into 4.5 is 0.045, 1.045. That has to be multiplied and get the square root. Because what we are going to do is, we are going to calculate the second year GMR, geometric mean return. So that will give the 2-year inflation. When you want to get the 3-year inflation, what you need to do is, you have to get the GMR for 3 years, and that is the 3-year inflation. 4-year inflation is, you multiply all these things, 4, 4.5, 5 and 6, and get the 4th root of that, minus 1. So likewise, you can get the, by going through the GMRs of these things, geometric mean returns of these things, you will get each year's expected inflation, average expected inflation, for 2 years, for 3 years, for 4 years, and for 5 years. Now, first of all, you do the calculation for the 2-year average expected inflation by going through the GMR, and GMR is 1.04 into 1.045 square root minus 1. So just do it and see whether the answer comes. So first of all, you calculate expected inflation for 2 years. It is not 4.5. Huh? It is just the second year inflation for the second year. Now I am asking for the 2-year inflation. 2-year inflation. Anyone who got the answer for 2-year inflation? 2-year inflation? Yes, 2-year inflation. I think it is not that difficult. As I told you, when you want to get the average inflation for 2 years calculated, what you need to do is, you need to get the each year's inflation and get the GMR of that, geometric mean return of that. Yes, very good, 4.25. So how are you going to do is it that you have 1.04 into 1.045 and the answer has to be square rooted. You get 1.0868 and the square root of that would be 1.0425. And it is in my calculator it comes as 0.042497. So it is approximated to 1.0425. So the answer would be 4.25. Correct. That is correct. So therefore, 2-year inflation is 4.25. Then we will go to the 3-year inflation. Just calculate that also. Yes, try to do the second one also, therefore 3 years. Yes, very good, 4.5. Yes, correct. You get 4.49 something, so then you can say 4.45. That is the 3-year inflation. And do the 4-year inflation also. Yes. Yeah, you should get 4.87. 4.87. Yes, correct. Correct. Others also can apply that and see whether you are getting the correct answers. And the last one, that is the 50-year inflation, 5-year inflation. There also you can do the calculation and see. Yeah, you get, yes, 4.99 is 5%. Yes, 5%. Right. Now we have been able to calculate the 2-year inflation, 3-year inflation, 4-year inflation, and 5-year inflation. and we can have a years or different years, and we can have a chart. I will put that chart on the board. Now, what you have found, I put as inflation for first to fifth year. First year inflation is 4%. Second year inflation is 4.25%. Third year inflation is 4.5%. Fourth year inflation is 4.87%. Fifth year inflation is 5%. Now, what else we have? We have the real rate. Real rate is 3 for each year. There's no difference. Real rate doesn't change. Now we need to have the yield. What is the yield? For the first year, it is 4 plus 3, 7%. Second year, it is 4.25 plus 3, 7.25. Third year, it is 4.5 plus 3, 7.5. Fourth year, it is 4.87 plus 3, that is 7.87. Fifth year, it is 5 plus 3, 8. So this is the way the yield curve is prepared. I think now you should be in a position to answer this type of a question if it comes in the examination paper. Any question on this? Now, are you okay with the explanation here? If you go into the question again, now these expected inflations are given, but what we did was we just calculated the inflation for year number 1, inflation for year number 2, and that. That's what we calculated. And we do it through the calculation of GMR. Then we plotted those things again and put the fixed rate 3% as the real rate. Real rate is fixed. But this is a special scenario. Normally the real rate also doesn't stay in one value, but it might change. But this is a special case. Anything which you want to clarify here? Yes, because rather than working out of a sum, you need to get good qualitative idea about these calculations or this why we are doing this and what are the analytical implications here. So that is what we need to understand. Right. Anything which you need to clarify here? Right. Now I will just give another problem. I will put it on the board. Now is it okay? Now this one is okay, no? So you don't need to get anything clarified here. Right. Right. I just put a problem on the board. Right. I will read it for you. If the YTM on a 12-year T-bond is 10% and similar 10-year T-bonds yielding T-bond is yielding 10.5%, what is the rate of a 10-year T-bond starting in year 11? You should work it out. Now you got the value for YTM for the 10-year bond and a 20-year bond. And what you need to calculate is what is the forward rate of a 10-year bond starting from the year 11. So how can you symbolize that? That is the first thing we need to understand. How do you symbolize? F, what? F, you are referring to 2 years, 10 and 20. F 10, 20. Then do the calculations accordingly. Now, anyone who can do the calculations for this sum? Simple enough. Dileepan, you can just try it again. Yes, correct. 9.5 is correct answer. If you make a small mistake, you might not get the correct answer. So therefore, be careful to do the calculations. So it is like, you need to get F1020. F1020 is equal to the 10th root of 1 plus YTM 20 to the power 20 divided by 1 plus YTM 10 to the power 10 minus 1. So that is the formula. So then you get the 10th root of 1.10 to the power 20 divided by 1.105 to the power 10 minus 1. Then you get the answer. The 1.10 to the power 20 is coming as 6.7275 divided by 1.105 to the power 10 comes as 2.71408. And if you calculate the ratio, that comes as 2.47874, and you need to get the 10th root of that. 10th root of that comes as 1.095023 minus 1 is 0.095023, and it is equivalent to 9.5%. So therefore, the 9.5% answer is correct. But what I feel is, now this is so straightforward and so clear. But what you need to do is, you have to be careful enough to put the correct formula and correct numerics. If you do it correctly, you will get the correct answer. And I think you all are fairly okay with the calculations, no issue. You might make some mistakes on and off, but you try your best to avoid such mistakes also. Right. We will have a small break now, and we will start by 3:30. Right. Again, come back to the session. So we have just done another problem with regard to the YTMs. Yeah. So now we have done number of problems coming under term structure and market interest rates. What we can do is now there's an examination question on this, so we will discuss that also. Right. Now, if we do that, I took a question paper. This is 2017 question paper. Yeah. And there's a problem or question on this subject area. Now, YTMs are given here. The following yield curve T-bond information should be used for the question number 4. Now, first of all, we need to calculate the implied forward rate for year 2. So, are you in a position to calculate that? You Yes. What I feel is now, if you been given a chance to do this, so you just see whether you can do the first part of it. Now, implied forward rate for year 2. So then how can we symbolize that? That is the first question you need to ask. ITMs are given. Yes, I am just giving you a chance to do this, just to do that. So what is the symbolization? You can say F12. F12. So then you know how to get the F12 calculated by getting the YTMs. Yeah, and you might get a simple answer for the first one. The question paper. Oh, actually, we will. I will hold a revision class, but that's a different case. But here, oh, right, I will do that later. Now, this one we will discuss this also, and afterwards I will just come to the inflation case, where this particular question paper is on 2017, if I remember correct. Wait, we will go to the paper. Yeah. Is 2017. Now, anyone who got the answer for this implied forward rate for 2 year, second year, 2 year one, for year 2. So that is for year 2. The skill is to have a correct symbolization, correct codes to be used. Now, this one, what is the code? That is the first question. The implied forward rate for year 2 is what? If1, F12. There is a code for that. Yes, correct. 9% is the correct answer. Yeah. No, what you need to do is you need to go by F12, that's the symbolization. That symbolization comes to the formula 1 plus YTM2 to the power 2 divided by 1 plus YTM1 minus 1. So that is what you get. So if you do the calculations accordingly, you will get the answer as 9%. So for the benefit of people who didn't do it, I will just explain it. Now you can just see what is the YTM for year 2. Though, in other words, we can say YTM2, that is 8%. YTM2 8%. So therefore, you have to have 1.08 to the power 2, which is to divide by 1.07, that is YTM1, 1.07. And it comes to 1.0900 something, minus 1 will give you the answer 0.0900. So 0.09 is equivalent to 9%. So the answer is 9%, that is correct. Now we can go to the second part of it. Determine the implied yield on a 2-year bond at the start of year 5. Now, when you say at the start of year 5, which implies at the end of year 4, right? And since it is a 2-year bond, it should end in year 6. So then what is the implied rate we are looking at in terms of F? we can say it is F46. F46. Now, since it is F46, how can you put the formula? How can you put the formula? Yes, of course. Now, I want to get your feedback. F46 is the code for that, because you need to determine the yield on a 2-year bond. The duration is 2 year. 2-year bond at the start of year 5. At the start of year 5 means at the end of year 4. It's a matter of 1 day or 2. So therefore, if you do that, it is correct in the years to maturity form. So then you need to have a forward rate calculation on F46. Now F46 means what? So YTM x6, that is 10%, 1.10 to the power 6 divided by, so you just do it. I mean, later on I will explain. You can't do it. Yes, shall we check? Now you try to get the answer for the second part of it. Yes, it's correct. Looks like correct, but it is more correct if you put 12.03, because if you come to the approximation, the next decimal is 7. So therefore, you can say 12.03 as the correct answer. Okay. Very good. Yes, any question? Now, shall I explain it? So it is like this. The question here is, you need to calculate determine the implied yield on a 2-year bond at the start of year 5. Now we are referring to a 2-year bond. 2-year means its maturity is 2 years. It is not the 2-year here, but 2-year bond. Now 2-year bond means we are referring to a bond starting in the year 5. But starting in the year 5 means now year 5 starting is the future event. Now we have to look at it from the point of view of a year 4. So 4 to 6 we have to get. So then therefore our symbolization is F4, 6. That is our symbolization. Yes. So then how are we going to get that F46? F46 is equal to 1 plus YTM6 to the power 6 divided by 1 plus YTM4 to the power 4. And you need to get the square root of that, because the difference between 6 and 4 is 2. second root is the square root. So then we need to get the square root of that. And -1 will give you the implied yield on a 2-year bond at the start of year 5. So that is the methodology. So I will just do the calculation for you. Now, yeah, any question? Yes. Now, as it is, the symbolization is F46, then the 6 related to 6 is YTM6, that is 1 plus YTM6 to the power 6. So YTM6 is equal to 10%. So 1 plus YTM6 is 1.10. And to the power 6 is, you press 1 YX, Y to the power X, and 6. (1.10) YX 6 equal to. That comes as 1.77156. And it has to be divided by YTM4 to the power 4. YTM4 is 9%. That is 1.09 to the power 4. That comes as 1.2550. The result comes as 1.2550. And we have to get the square root of that. And that square root comes as 1.120276 something. And you need to deduct 1 from this, and you get the answer 0.12027, that is 1203, that is 12.003. So this is the answer for the second part of it. So I think it is clear enough. Yes, any question? Now, Isiri and Rivini did the answers correct. Anyway, the others also can try that and see what it is. Right. Now, shall we go into the next part? Determine the implied yield on the 4-year bond at the start of year 7. Now, I think you realize, in order to correctly work out the sum, you need to get the correct codings. Now, when you say determine the implied yield on the 4-year bond at the start of year 7, what is the coding? F610. If we can put it as F610. Between 10 and 6, you have 4 years. No, that is why the 4-year comes there. F610. Now, F610 relates to the 1 plus YTM 10 to the power 10 divided by 1 plus YTM 6 to the power 6. And its 4th root -1 will give you the answer. If it is necessary, I will put those things on the board. I don't know. It is not necessary because people are not really following, some of the people. So anyway, if it is necessary, I will do that. So shall we go for the answer for that? The third part. So you have to have the implied yield on the 4-year bond at the start of year 7. So first of all, you need to get YTM 10. 1 plus YTM10 to the power 10. So YTM10 is 11.5. Right. I can just check whether you did that. Yes, good. You did the answer. 13.79 is the correct answer. Now, there also, what you need to do is you have to code the things first. That is F610. F610. That can be symbolized as 1 plus YTM10 to the power 10 divided by 1 plus YTM6 to the power 6, and the square, fourth root of that minus 1. I will work it out on the board. For the benefit of others who couldn't do that, they couldn't do that. And anyway, I am referring to the third one, no? And it can be symbolized as F610 equals to 1 plus YTM10 to the power 10 divided by 1 plus YTM6 to the power 6, fourth root, and it can be taken this way. YTM10 is how much? $11.5 and YTM6 is 10%. 11.5 and 10%. So then here you get 1.115 to the power 10 divided by 1.1 to the power 6, fourth root minus 1. We will give the answer for this. Now, when you get 1.115 to the power 10, you take it as 1.115 to the power 10. That comes as 2.9699. 2.9699 divided by 1.1 to the power 6. That is 1.7715 or 16. You have to get the fourth root of that. $2.9699 divided by 1.7716. The whole thing, we have to get the fourth root. Let's go. That is 1.13787. That is equivalent to 0.13787, that is 1379, or it is equal to 13.79. So this is how the answer comes. Any questions? Any clarifications on that? Any clarifications on that? Right. Now what I feel is now most of you would be in a position to work out the sums like this. But only issue is very few people just come to the active participation. That is the issue. But anyway, this for your interest, I ask you to just participate in the things actively. Because you just looking at the things and just listening to the lectures, I don't think that you can get more things. Only thing is you need to activate yourself practical. That is the most important thing to be done. Okay. Yes. Now, this type of question is not a very regular one in the question paper, but there can be a chance of having this type of a question. But if you go through the several past question papers, you don't find much of this type of questions. Right. When we get through again to the notes, oh, this liquidity premium hypothesis is a very important one, and that's what I want to just explain to you. And it is really worthwhile in analyzing the bond markets and all. And the yield spreads is the next very important one. So I will just give you another small problem, and that you can do now. The question. Right. Now I have just put something on the board. Right, just look at it. On June 6, 2020, the following YTMs were existed for long-term bonds. Government treasury bonds, it was 9.5%. AAA corporate bonds, it was 10.1%. AA corporate bonds, it was 10.7%. A-rated corporate bonds, 11.4%. And BBB corporate bonds, it was 12.46%. Now the question asked is, determine the yield spread of AAA rated and AA rated bonds. That is the first question. The second question is, determine the yield spread of A rated and BBB rated bonds. Now, when you say the spread, what do you mean by that? The spread, the meaning is, what is the additional amount of interest to be paid as against the government treasury bonds yield? That is what you mean by yield spread. Because the government treasury bonds are normally considered as risk-free, default risk-free. That is why we have to calculate the spread as against the government treasury bond rate. Right, with that, can you answer that question number 1 and 2? Very simple. Very simple. So therefore, I will ask you to put it in this basis points. The spread has to be given in basis points. Yes, first question you need to try first. You make an attempt on the first question. Yes, I think this is a very easy question. If the things are clear enough, the answer should come immediately. I think all of you can try this, and this is a very easy one. Yes, if you put it in basis points, that would be better. Yes, you can come up with the answer. Is it clear? The question is clear? The question clear? Now, when you talk in terms of spread, spreads are normally calculated as against the treasury bond rates. Now, treasury bonds are normally regarded as risk-free. So therefore, corporate bonds invariably have a higher interest rate than treasury bonds. Therefore, there's a particular spread when you compare it with the treasury bonds. I think it is too easy. Uh, 5.6 and 6.2. Oh, there's no big deal here. It's a small thing. It's a very simple thing. Simply the yield spread is the additional amount. So government treasury rate is given here. Government treasury bonds 9.5. It is 9.5. Right, good. 0.6 and 1.2. Yes, correct. 0.6 and 1.2. That is, no, these are very simple thing. I don't know, because you have not noticed the government bond rate. That is why you had an issue. But anyway, now you got it correct. And rather than telling it as 0.6 and 1.2, what is the other way you can put it? In basis point form? If you can put it in basis points, you can say 0.6 as 60 basis points and 1.2 as 120 basis points. So I think you better better do it in that manner rather than giving it as a 0.6 and 1.2% as a percentage. So spreads are normally given in basis points. Basis points. Just put it in basis points and tell me. I will show you what is a basis point, right? Now, 0.01% is equal to 1 basis point. Point 0.01% is equivalent to 1 basis point, because this particular notation is very important for your financial analysis jobs or matters. So the financial world normally quote the rates in basis points or spreads, especially the spreads given in basis points. So therefore, that notation is very important for you to remember. Yes, very good. 60 and 120 basis points would be the spreads given in basis points. Very good. Now do the answer for the second part also. Do the answer for the second part also. So for the second part, it is asked A-rated and BBB rated bonds. Yes, good. 190 basis points for the A-rated bonds. The spread is that, because the A-rated bond is its YTM is 11.40 and treasury bond rate is 9.5. So 11.4 minus 9.5 will give you 2.9. That is equivalent to 1.9. Sorry, 1.9. That is equivalent to 190 basis points. And if you take the BBB rated bonds, the rate is 12.46, whereas the treasury bond rate is 9.5. So the difference between that is 12.46 minus 9.5 is 2.96 in percentage terms, and it is 296 basis points. Good. So, but what I want to tell you is, even though these things look easy, but you have to be careful and you need to have a clear idea about it. Otherwise, what happens is, now, even though it is easy, you might get it wrong. So, in order to have every time the correct answers, you need to have a clear idea, very clear idea about it. Right. Now, as it is, today we discussed about several interest rate implications, and we talked in terms of real rates, we talked in terms of inflation rates, we talked in terms of risk premiums and all that. But the market will decide all these things. And when the market decides about the interest rates, it might go through several type of hypotheses. The one hypothesis is expectation hypothesis, where we have already done our maths and all. We did several quantitative methods in order to do that forward rate calculations and all that. That is what you call expectation hypothesis. Then we have another hypothesis on liquidity risk hypothesis, so liquidity preference hypothesis. And the third one is the segmentation hypothesis, where you have different segments and for each segment you have a different supply demand positions. With that, you have specific spread or specific interest rate attributable to the segmentation. So this is the theory part of this market interest rates and term structure of interest rates for the time being. And I want to just explain that inflation thing for the benefit of one person asked that question. And I will again go to that question and just explain the inflation. The question number 4 in my lesson number 7. Yes. Right. Now I will read it again. But what I feel is, now you were not there when I just explained this. I just explained it earlier, and I think that explanation was quite adequate. But anyway, since you have asked that question, I will just explain it again. Suppose the real rate is fixed at 3%. So what do you mean by rate is fixed? Means for the whole 5 years, the real rate remained as 3%. That is what you need to understand. If the following inflation rates are expected for each of the next 5 years, so that means the inflation rate was given for particular year. Now, in that case, what we got was the inflation for year number 1 is 4%. The inflation for year number 2 is 4.5%. The inflation for year number 3 is 5%, and inflation for year number 4 is 6%, and inflation for Year number 5 is 5.5. But when you determine an yield curve, what happens is you have to go for different maturities. Now, maturities in the sense you can't go by just having the second year, just having the third year, and so forth. What we need to have is, first of all, you have to go for a 1 year maturity bond, 2 year maturity bond, 3 year maturity bond, and 4 year maturity and 5 year maturity bond. That is how you should go. So therefore, rather than getting the inflation for each year, you have to get the inflation for cumulatively for 2 years, cumulatively for 3 years, cumulatively for 4 years, and cumulatively for 5 years. Now, how are we going to calculate that? In order to calculate the inflation for 2 year term, what we need to do is you need to go for the each year's inflation rates GMR, that is geometric mean return or geometric mean value to be taken in order to get the 2 year inflation. It is not a year 2 inflation, we can call it 2 year inflation. The time period is 2 years. So in order to do that, what we can do is you can multiply 1 plus 4%, that is 1.04, with 1 plus 0.05, and it has to be square rooted. Minus 1 will give you the 2 year inflation rate. But 1 year inflation rate can be the same as 4. There's no change in that. You can put it as it is. It is 4 because there's nothing added there. No? So therefore, the GMR of 4% for 1 year is same. But if you get the second year or 2 year inflation rate, that can be calculated by multiplying 1 plus 4%, or that is 1.04 into 1.045. The square root you have to get, and after getting the square root, you have an answer. So that answer is yes, that answer is 1.0425. Sorry, that is 1.0868, and you need to get the square root of that. That square root is 1.0425 minus 1 will be 0.02425. So therefore, for the second year, for 2 years, the inflation rate would be 4.25. Now, when you go to the year 3, so 3 year inflation rate you have to calculate. There, what are you going to do? You have to get into consideration, take into consideration 1 year inflation, 2 year inflation, and third year inflation. That is 1 plus 0.054. That is 1.04 into 1.045 into 1.05, and you have to get the third root of that. And minus 1 will give you the inflation rate for 3 years. That will come as 4.5. Inflation rate for 4 years can be calculated by multiplying 1.04 into 1.045 into 1.05 into 1.06. And whole thing we have to get the fourth root. Then minus 1. And when you get the multiplication, you get the value 1.2096084, and fourth root is taken as 0.0487. Sorry, 1.0487, and when you deduct 1 from that, you get 4.87 as the inflation rate for 3 years. And in the same manner, you calculate the inflation rate for 4 years. That comes as sorry, the 4 year rate has come as 4.87. Earlier one, the 3 year rate come as 4.5, and the 5 year inflation rate came as 5%. So now you have 5 values for year 1, 2, 3, 4, and 5 inflation rates. So for the 1 year inflation rate is 4%, 2 year inflation rate is 4.25%, 3 year inflation rate is 4.5%, 4-year inflation rate is 4.87%. 5-year inflation rate is 5%. Now what you can do is you can tabulate all these things, and you have to, in order to get the risk-free rate without adding the risk premiums, what you need to do is you need to add the inflation rates to the real rate. Now you know that real rate is fixed at 3%, so therefore the market rate or risk-free rate can be taken as 3 plus what you have calculated. So that is the yield curve for the bond. I think that is clear enough, or what do you think? Is that okay? The inflation thing? Right, good. Now, there can be several ways of giving you questions on this, but you need to understand the fundamentals of that. If you don't understand the fundamentals, it is very difficult for you to answer a question. Though these things are very straightforward and very easy, but the clear understanding is necessary. That is why I asked you to just work it out on your own, rather than just listening may not help. Then I will discuss another sum. So that is a little difficult and little challenging. That is why I have not put it in the lesson itself. And I will just explain it. Right. I will put that on the board. Right. Now you look at the things on the board. Better you can, if you can write it down. The following $2,000 face value zero coupon bonds are available. Right? And the bonds are given as one bond is named as ABC, the other one is named as XYZ. And the price given, this is the purchase price. Now all these bonds are, two bonds are zero coupon bonds. And the price is given as $900 for the ABC bond, and the maturity is 1 year. And if you take the XYZ bond, that's maturity is 2 years and price is $785. Now, the question is, I think you may not understand that question. Anyway, I will explain that what it is. Show how the forward rate starting in year 2 could be locked in by a bond trader. Now, forward rate starting in year 2. Forward rate starting in year 2 could be locked in by a bond trader. Now, what do you mean by locked in? Locked in means the particular bond trader should avoid having a loss on that. That is what you mean by locked in. So anyway, before going into that, we need to calculate two things. One is, now there are two bonds given here. For the first bond, you can calculate the YTM for 1 year bond. Right? The YTM for 1 year bond can be calculated. And YTM for 2 year bond also can be calculated with the given data. So the first of all, what you need to do is, you need to calculate the YTM for 1 year bond, since it is zero coupon, and YTM for 2 year bond. Just do the calculations now. Now you know how to calculate the YTM for a bond. Zero coupon bond, it's easy. Since it is a zero coupon bond, it's easy. It is very much easy to calculate the 1 year bond, but the 2 year bond has a little additional work. Right. I think, you can give it soon, the answer. First of all, you give me the answer for the YTM for 1 year bond. Yes. Uh, 10%. You are referring to the year 1 year bond, YTM. Though the face value is 1,000, you are not going to get the face value as the investment. No, investment is only 900. So therefore, how are we going to get this? Right. Not 11%. It should be, what is that? Correctly put it, not 11. 900 divided by, 100 divided by 900, because 100 is the amount of interest. Because on the maturity, you will realize 1,000, whereas you purchase it at 900, and the interest upfront is 100. 11.11, yes, correct. 11.11 is the answer. That is the YTM for 1 year bond. YTM for 1 year bond. And just get the YTM for 2 year bond also. It has a little challenge, but I think you all can do that. Make sure that you do the correct thing. Yes. Now, I think you need to have that challenge, because just do it, and then if you can't do that, I will explain. To get the YTM for the 2-year one, which is priced at 785. Because it has a maturity of 2 years. That is the issue. Now, since it has a maturity of 2 years, you have to have a little thinking, little additional thinking. Now, since you pay only 785 to purchase a $1,000 bond, what is the amount of interest? 1000 minus 785. That is the amount of interest, and it comes to 250. What is your yield? Yield would be 215 divided by 789. That is the yield. But you get it for 2 years. You have to get the effective rate for 1 year, because normally you give the YTM for per annum. So that is what we need to understand. It would not be 13.69, because 13.69 comes with 215 divided by 785. That comes as 27.38, and you get the half of it, and it is 13.69. So what you did is a certain approximation, so it is not the correct accurate thing. I really appreciate your attempt. It's not a linear type of thing. That is what you need to understand, right? Yes, 12.86 would be the answer. It should be, accurately it should be 12.87. Accurately it is 12.87. Just to see the way it needs to be done. Now, say for example, if you do an investment and at the end of the investment you would get 1,000. So therefore, how are we going to just get the rate? 1 plus what? 215 divided by 785. 215 divided by 785 is what? 215 divided by 785. You get 0.2738 plus 1 point something. Then you get the square root of that. Minus 1. And you get 0.12866. That is why I told the YTM would be 12.87. Now easily might understand what I said because your attempt is okay, but you see the difference. Huh? You got the answer as 13.69, but the real answer is 12.87. So there's a rather substantial difference. Good. Now what you did was, I think what you did was you just got 0.27, that is 27 point something, and you just divided by 2 in order to get the 1 year rate. That is what you did. Anyway, it's a type of approximation, but it is not 100% correct. Anyway, so I really appreciate that attempt. The Malinder's answer is correct. It is 12.87 should be. And the way it should be done, now what we need to do is you get 215 as the interest, and that interest is taken on to 785, and when you calculate the ratio, you get 0.27 something, and since it's a type of income for that, you put 1 plus 0.27 something, and you need to get the square root of that and minus 1. Then you get the effective rate for the 1 year. 2 year bonds rate in annual form. So that comes as 12.67. So now I will put a chart like, YTM1 is equal to 11.11. YTM2 is equal to 12.87. Now with that data, are you in a position to calculate the forward rate for year 2? You should be. Now do that calculation also. You got my point. Now say, we calculated the YTM for 1 year bond and YTM for 2 year bond, right? Bond. XYZ, sorry, ABC. Can you see this? So yes, ABC, XYZ. Then we say year 1, 2. YTM. The first YTM is 11.11%. The other one is 12.87%. Now this is the chart. This is the chart. So if you have the chart like that, are you in a position to get the 2 year forward rate? Now how do you symbolize that? F12. F12. Right, do that. Yes. Now can you come up with the forward rate? Now, as you just look at the chart, the top above chart, so there you find years 1 and 2 and respective YTMs. With that, you should be in a position to calculate the 2-year forward rate. Now, in order to get this lock-in device means now, say the particular rate, if that particular one trader is going to have a loss on that, he has to avoid that. That is what you mean by lock-in, right? This particular language you have to understand, and you have to be familiar with the language here, because you are really doing a subject which is very much needed in financial analysis. $14.66, yes, correct. I think if it is very correct, then it should be 14.67. There can be small differences in your decimals, but it doesn't matter. But if you have followed the correct methodology. Now, as it is, I can tell you F12 is the symbolization, F12, and it is equal to 1 plus YTM2 to the power 2 divided by 1 plus YTM minus 1. So when you say 1 plus YTM2 to the power 2 means, what is YTM2? We calculated it as 12.87. Then you can say 1.1287, you have to get the square. That comes to 1.27396 something. And that has to be divided by 1.111. Sorry, 1.1111. And it should be equal to 1.14656. Okay. Yes. So 1.14657 you get the answer. And if you deduct 1 from this, you get the answer as 0.14657. So that means 0.1466. The answer is correct, right? Good. 14.66 is correct answer. I think others also should understand the methodology first. And I don't know why 14.64 comes. I think there are some small figure has been omitted or something like that. That is why the 14.64 should come. Otherwise, it should be 14.66. Right, of course. Now, I will just explain the other part of it. Now, the question is regarding how the forward rate starting in year 2 could be locked in by a bond trader. Now, locked in means if the trader is going to incur a loss, how can that loss be avoided? That is what it is asked. So, how are we going to do that? Now, in the first year, what is the rate? Now, the YTM for 2-year bond would be 12.87, right? Right. 14.88. Shall we just do the calculation and see what it is? Now our coding is this. F12 is equal to 1 plus YTM 2 to the power 2 divided by 1 plus YTM minus 1. Now here it comes YTM2 is 12.87, so therefore 1.1287 to the power 2 divided by 1 plus 1.1111 minus 1. And here you get 1.1287 squared is what? That is 1.27396. 1.27396. And it is to be divided by 1.1111. That comes to 1.14657. So this is point minus 1, that is 0.1466 or 14.66. This is how this comes. Now if you have a small mistake there, so you need to know why it has happened. And it can be a rounding off error or something else. If it is a rounding off error, it doesn't matter. But if you have another type of error, so then if it is a fundamental error, then you might get penalized for that rather than approximation. And Madhuma, you get 14.88. I don't know how it comes. Anyway, it doesn't matter. Whatever the answer you get, I really appreciate, because since you have already attempted something, so that's a good thing. Just to be silent would not be help for you. So therefore, you all should try to actively engage in these things. Then you can get something, and even the others also can be activated through that. That is the necessity here. Yes. Now I will show you how this particular thing can be done to lock the things. Now locking in the sense to avoid any type of loss and gain some profit, some surplus. That is the requirement of locking. So shall we see how it can be done? Now you need to have some idea about these bond selling mechanisms, where a thing called short selling is there. Short selling. Now what do you mean by short selling? You can sell something which you don't have. That is what you mean by short selling. So now, as a result of short selling, what you will have? You will get money, because you sell something and you get some money for that. But you didn't own that. You borrowed it from someone and sold. Then first, at the first instance, you have to settle that. You need to settle that. So therefore, first of all, what you need to do is you need to short sell the bond of $1,000 or the 1 year bond for $900. And you get the proceeds, 900 proceeds. and purchase now for 900, how much you can purchase XYZ bonds? Because it is only 785. If you want to purchase a XYZ bond, you need to spend only 785. From 900, how much you can purchase? 900 divided by 785 of bonds purchased. So that means you can purchase more than one bond from 785 bonds. So that is, what is the amount? 1.1465 bonds of 2-year bonds can be purchased. Now, when the bond matures, at the end of the year 1, when the bond matures, you will be able to settle the bond with the proceeds. Anyway, now this particular thing I can explain on the board, but before that, okay. I just want to ask the question. One person just asked me to explain the inflation thing. I don't know whether the person is there, and it is got correct. Yes, Deepika. Yes. Okay. Right. Now this particular thing. Now this is like a story, like, because the bond traders and what they do is really interesting. Now this particular bond trader, what he is going to do is, now we have calculated the quantitative things here in order to show what is happening. Now the bond trader, what we would do is, or even we can recommend him to do that. And first of all, what he can do is, he can at the end of the year, at the end of the year, he will be in a position to short sell the bond number 1, that is ABC. And when it is being short sold, he will get $900 to his hands. And out of that 900, he can purchase 2-year bonds. How much? 2-year bond is only worth $785. So for 900, you can purchase 1 plus another fraction of that bond. That is what happened. Then at the next instance, what he will do? Now he will get the proceeds of 1,000, since he has short sold. No, short sold means now he has not sold the real one. So when he get that 1,000 as the maturity proceeds, he can use that 1,000 rupees to purchase or to right. Now what happened is, now he will get $1,000 at the end of the year 1. Now that $1,000, what he will do? He will have to spend that to settle the treasury bill, ABC. The bond has to be settled at the end of the year. Why you settle? Because you have short sold that. There was a short selling of that. Since it is short sold, what happened? You have to borrow money, you know. You have to borrow a particular bond. That bond will have to be settled at the end of the year. So you have to make use of 1,000 to, I mean, that 1,000, when the maturity proceeds come, you have to settle that one. So then what will happen? At the end of the year two, what are we going to do? You will have now that bond of 1.14 something bond, and you will receive as maturity proceeds 1,146 something as proceeds. Now what is your ultimate gain? You spent 1,000 and you received 1,146, and your gain would be 146. So that is how you avoided the loss. That is how you avoided the loss without doing any other things. Otherwise, he would have a bigger loss. Right. With that, I just want to, before winding up, I want to get your feedback on today's lesson. Not only that, I will have to give you a certain assignment. Right. And IBSL authorities just informed me that the examination will be held on 4th of October. 4th of October will be the examination. And before that, we will have some question paper discussions in the next session. Right. So there, I will give you the assignment also. There will be an assignment, and that carries 30 marks. Right. So that would be a comprehensive assignment, and you have to be careful about that. And if you have any issues or any type of unknown type of things, I will just help you. But you have to be careful, and you need to clarify any things which you don't understand. But there will be a deadline for that assignment, and you have to meet the deadline. If you don't meet the deadline, there will be penalization. So with that, I just want to get from you anything, any feedback for today's lesson. If I can give you another 2-3 minutes for that. Yes. Anything? I really appreciate there are some people who joined with the class: Malinda, Isiri, Rivini, Subhasingha, Madhuma Valpola, Deepika, and all that. I really appreciate their active participation. And all others should have Dilan, Shanili, yes, Rivini. You can see the names. Okay, so that's good. So, but I have seen, and there's another person, Dileepan, no? Dileepan, Adhikar Kumar, Nirodhi, Dileepan, and all these people. Actually, I really appreciate their active participation. So in order to give them, give the other people also a boost, so you all should participate. Right. With that, if you don't have any other clarifications, I wind up for today. Thank you very much.